speaking of bad brands, I bought one. Well, it's not a bad brand yet, but I rebought the Abercrombie and Fitch. Now I got my toe, a fraction of my toe in the water. So this is a sub 1% starter position in ANF at 72. And I've traded this. I made a little money. I've not made money. I haven't lost anything. So one of these days I'll hopefully find the bottom. I'm assuming the numbers are the word I read on my Bloomberg was that Hollister's is starting to discount more aggressively. Abercrombie's not. It would make sense in a K-shaped economy, perhaps. But so I'm blind here on the numbers. I have no feel or edge or insight that's been put out by Wall Street about how the quarter looks. But I'm just buying pure valuation. And the valuation numbers are very interesting. So at around 70, it's trading for like a $2.9 billion market cap. There's $700 million in net cash. If you don't factor in, the lease issue, the leases that they have, long-term and short-term, which, by the way, are the same dollar value that they've been at about 10 years ago. So even though they're much bigger and have more stores, they've been working their lease prices down, I would guess, per lease. It's the enterprise value is down to $2.2 billion, and EBITDA is $800 million. So it's actually under 3 times EBITDA. Yeah. And it's 40% EV to sales, 0.40.
Yeah.
So if it could trade up to Under Armour's, it would double.
I would actually personally, I would take a crack. Not in either, but I would take a crack at Abercrombie before I took a crack at Under Armour.
And to get to the 40, I had to cheat. I had to say that the share count, which is 48, will go from 48 to 45 to 41 because they're buying 1 million shares a quarter. And I said in 2019 or 20, there was 70 million shares on the stock, 69.7 to be exact. And there was 47 million shares, I believe, last quarter. And I think it'll be closer to 40 by the end of next year. So I'm using a 40 million share count on the $72 stock price, which is $2.9 billion.
And that's like $10, almost $10 a share in free cash flow.
So it's
approaching 15% free cash flow yield. The question, the real tricky thing though, is they've been doing $400 or $500 million of free cash flow the last few years. If you go back to before the turnaround, I think it was more like 1 to 200. So
it was, yes. They've sort of had an inflection point in their profitability a couple of years ago. And like Crocs, the street might never pay for it, right? It may believe it's unsustainable, and they're going to lose it at some point. So
I think, but they've got a better edge than Crocs. Abercrombie's always it's they never get both divisions quite cracking at the same time. It might be because the socioeconomic. But no matter what they report, the rap on them is always that kind of one side is picking up the other. And Hollister took that reign over that. That's why the concerns over Hollister, what's dragging the stock down so hard, is because Abercrombie hasn't been any great shakes for the last couple of years. That said, Abercrombie was coming off an absolutely screaming hot run for, just kind of putting up crazy numbers. I think the place is well managed. I mean, it's hard for me to see kind of both those divisions tanking at once. It weirdly trades at almost a discount to what it would be if you just kind of let them be their own sort of specialty shops, or it's because they treat it like they just don't have any good ideas. I think what's really happening is they're cannibalizing one another to a degree, which is why they kind of can't get out of their own way. But then you add them together and it's like, well, between cannibalizing themselves, they've got a lot of leases, but they've been cutting them back. They've got a lot of shares, but they've been buying them back. They generate cash, and they're pretty good at running these two chains if you stuff the numbers together. But that's a pure reaction stock, as you know. I've seen you win on it, and I've seen it come all the way back down. And in both of those cases, it was just they reported quarters that overall were fine, but there were warts on one side of the business.
Yeah,
and they get really disproportionately hammered for any kind of weakness.
Yeah, I took a crack at this, I think, in the beginning of 24 unsuccessfully. And then it was like the opposite story, right? Like Abercrombie was slowing and Hollister was on fire. It is just, there's always, they just never seem to be able to get both of them going at the same time.
But
there's always
that's a
something
reason
to
to
there.
kind of question whether they can be the next $50 billion merchant, but they're not anywhere near that. So it's to Robert's point. I like the trade as well. I mean, it's 3 thumbs up.
They'll struggle to get to 10 billion from 5 billion over 10 years probably. But
They couldn't give the damn place away for 1 billion 10 years ago. So they've done one hell of a job, and I think it's a well managed company.
Incredible turnaround. Yeah.
10 years ago, I didn't think they were going to be able to get the stink of sour cologne out of it, and let alone the ghosts of all the Abercrombie boys that stood out front and sold product. They managed to turn that place around way beyond what people expected, and Hollister's a pretty good chain. So I like the trade.
Hi, I'm David Maris. If you like what you just heard, we've tracked every single pick we make on the show, every ticker, every thesis, every entry price, over 1,100 picks and counting. We put it together in a free report with our top 10 performers, the reasoning behind each one, and a preview of our full dashboard. If you want access, the link is in the description.